Ladies and gentlemen, good day and welcome to the Balkrishna Industries Limited Q1 FY23 earnings call hosted by Anand Rathi Share and Stock Brokers. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vijay Sarthi. Thank you, and over to you, sir.
Thanks, Aman. Good morning, all. On behalf of Anand Rathi Shares and Stock Brokers, I welcome you all to the first quarter FY23 results call of BKT. From the side, we have Mr. Ajay Purva, the Joint Managing Director, and the management team. As always, we will start with the initial review about the results and then follow it up with Q&A. Thank you, and over to you, Mr. Ajay.
Thank you, Vijay. Good morning, everyone, and thank you for joining us today. Hope all of you, along with your near and dear ones, are safe and healthy. Along with me, I have Mr. Bajaj, Senior President, Commercial and CFO, along with SGA, our Investor Relation Advisor. Let me begin with performance updates. We continue to see a sustained uptick in demand for BKT tires. However, in Q2, we expect sluggish demand given macro challenges in Europe, coupled with heat waves and inflationary trends in US. However, our continued focus on customer servicing, especially in the last few years, since the start of the pandemic, gives us the confidence to outperform the competition. We continue to grapple with high costs, especially on the logistics front. In the current quarter, the logistic costs have come at 14.2% of sales. This is versus 7.1% in Q1 FY22 and 13.8% in Q4 FY22. We expect relief in logistics costs towards the end of Q3 or early Q4. Raw material prices have also remained at elevated levels. In the current quarter, raw material costs have come at 46.6% of sales versus 42.8% in Q1 FY22 and 45.3% in Q4 FY22. We expect some relief to come in Q4 of the financial year. Accordingly, we expect a better margin outcome in the second half of this financial year. Let me now talk about our capex plans. During Q4 financial year 22, we commissioned the 50,000 metric ton brownfield tire plant at Bhuj. We expect complete ramp up in the production to be achieved in the second half of this year. The total achievable capacity in the tire segment will be 360,000 metric tons per annum by the end of financial year 23. Carbon black, we expect the commissioning of 55,000 metric ton per annum of carbon black project along with the power plant during Q3. The advanced carbon black project of 30,000 metric ton will be commissioned in Q4 of this financial year. With this, I now move on to operational highlights. Our sales volume for the quarter was 83,153 metric ton, a growth of 21% year on year. Our standalone revenue for the quarter stood at rupees 2,726 crore, which includes realized gain on foreign exchange sales of 80 crores. For financial year FY23, 50% of the sales came from Europe, 21% from India, 20% from America, and the balance from rest of the world. In terms of channel contribution, 70% was contributed from the replacement segment, while OEM contributed 28% with the balance coming from offtake. In category, agricultural sector contributed 64%, while OTR, industrial and construction contributed 33%, and the balance came from other segments. The standalone EBITDA for the quarter was at 547 crore with a margin of 20.1% EBITDA. The EBITDA for the quarter has been impacted by higher logistic costs and raw material costs, in addition to higher power costs and investments in brand building for the quarter. Other income for the quarter stood at a loss of rupees 15 crore, while unrealized gain stood at rupees 26 crore. The other income loss was on account of MTM, loss of investments in equity mutual funds and debt. Coming to the net forex items, for the quarter, we had a net forex gain of rupees 117 crore. This includes realized gain of 91 crore and unrealized gain of 26 crore. Profit after tax stood for the quarter was recorded at rupees 320 crore versus 331 crore for Q1 in financial year 22. Our gross debt stood at rupees 2,752 crore at the end of 30th June 22, of which rupees 2,251 crore is related to working capital debt. Our cash and cash equivalents were at rupees 1,972 crore. So far, we have incurred a total capex of rupees 1,322 crore on the ongoing capex program of rupees 1,900 crore. For Q1 financial year 23, the euro hedge rate was rupees 85. The forward hedge rate currently stands at rupees 85 for the levels for the financial year 23. For financial year 23, as guided in the last earning calls, we foresee sales volume of 320 to 330,000 metric ton, considering the capacity enhancements from ongoing projects, which will come online by the end of first half of this financial year. However, there may be short-term challenges on account of inflationary trends, rising interest rates, as well as weather patterns in Europe. The board of directors has declared a first interim dividend of rupees 4 per share. With this, I conclude my opening remark and leave the floor open for question and answer.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Hi, sir. So firstly, on the margins, if I look at quarter on quarter, because the freight rate has gone up almost 3 rupees per kg and RM cost also increased, I think you broadly were able to compensate effect of this RM and freight cost increase quarter on quarter. But other expenses are shot up almost significantly if you remove the expenses, remove the freight cost. So almost there is a 27% increase quarter on quarter in the other expenses. So what's the reason behind that? Is there any one-off over there?
So there are two things on that. One is if you see the numbers, you need to account for the higher turnover in this quarter as well. So you need to put that. And also, as I said, the power cost has also affected us. And some part of the branding which has come in this last quarter, which has also come into play in the particular quarter. The payments have come in that quarter.
Sir, I think the volumes have gone up roughly 8% quarter on quarter, but the other expenses have gone up 27%. So can you just break it up, the power cost increase quarter on quarter and this branding cost increase?
I don't have the breakup right now, but we can connect off to that.
Okay. And you also mentioned some losses in other income. Can you just quantify that or throw some light on that? Some losses on equity mutual fund and the debt mutual fund you mentioned, right?
So there is an investment portfolio which was created last year, and to the extent that there is some losses in the equity and the debt portion of the investments that have been made. These are not cash losses, these are MTM in nature, and there can be some reversals going on.
So that's why other income is negative in this quarter, adjusting for forex gains?
Yes.
And lastly, on the outlook side, you mentioned that there are some challenges in Europe. So is it because of this whole heat wave is the reason behind Europe, or is there some other reason behind that?
Yes, as I said, the weather patterns in Europe are playing a role. So the heat waves which have just recently come.
Thank you, Mr. Tewari. I request you to join the queue for any follow-up. Also, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to 2 per participant. If time permits, you may join the queue for any follow-up. We have the next question from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi. Good morning and thanks for taking my question. Couple of questions. One, on the freight rate side, like you mentioned, you expect that to come down in Q3, Q4. So just want to understand what portion of the freight cost are you passing on? How much is FOB and how much is on a CIF basis, and how much are you passing on as a surcharge? So what is effectively what we are not passing on?
Okay. So our 50% contracts are on CIF basis and approximately 50% are on FOB basis. And from the CIF basis, whatever we were there, on 50% we were able to pass roughly.
Got it. So basically on 25% of our export volumes, we would not be able to pass, right?
Yes.
Right. So as a result, then, I mean, that passing on is coming as a higher realization as well, right?
Marginally higher, yes. Not the whole impact of it, but marginally higher.
Got it. Got it.
Passing was also not fully, it was partially.
Okay. Okay. So the CIF bit, then we can assume that 30 to 40% of CIF customers is not passed on. And just, I mean, continuing with Ashutosh's question on the demand outlook, and especially for the European market, I mean, like, what are you seeing? Is the market actually shrinking given the geopolitical issues? And I mean, if you could just talk about especially the agri-tire market, what is your expectation?
So as of now, what we are seeing is there's no shrinking or anything. It is challenging. So we are just, I mean, there's uncertainty and there's a challenge over there. Maybe, this quarter could be a little challenging, but overall the demand is yet not, it's not shrinking or anything. So we are confident of the numbers, but this quarter you may not see, this current quarter may be a little bit of a challenge.
No, so that is coming because of then are the distributors cutting back on the inventory levels, or what is happening? Yes. I'm just trying to understand, like, the end retail demand, how is that sort of moving?
End retail demand as of now is yet good. The distributors are cutting back on their stocks, what we are seeing, because of the uncertainty in the market space.
Got it. Thanks. I'll join back with you. Thank you so much.
Thank you. The next question is from the line of Lokesh from Vallum Capital. Please go ahead.
Yeah, hi, good morning, Rajiv and team. Just one question on my end. We have seen the number of SKUs increase from 2,700 to 3,200. And the quarterly volume has gone up from a run rate of approximately 65,000 to, this quarter at 83,000. How much would you attribute, that to the increase in SKUs? Just a broad idea, not anything specific.
So the SKUs were built up it's not gone up in the last quarter. The number of SKUs have actually gone up in the last 1 year to about 15 months. Okay. And it's an impact of all of that coming together. So new SKUs help complete the basket. So trial lots of that are there, but with that the entire basket has gone up. So it's not fully attributable to only the new SKUs. This is for the mix. The basket rate remains the same. So new products.
I'm just trying to understand the incrementally how much is coming from the new SKUs. Just an idea in terms of.
So it's very
volume
difficult
growth?
to give you a breakup like that as to what is the breakup for new incremental sizes and all. But overall, it is added to the basket. So the sizes have always been added to complete the basket. As our part of our vision to be a single stop supplier for off-highway tires.
Okay. But do you see that there is still more scope with this new SKUs, more scope for volume growth going forward?
Yes, of course. Yes. I mean, if you see that, with this current uptake also, we are at about 6% of the market. So, there's over 90% of the market available in that sense to grow. And the market itself is also growing, so there is huge scope.
Okay. And that's it from my side. Thank you so much.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. A couple of questions from my side. Firstly, can you share the data points on what was the RM cost or commodity cost impact in this quarter? Hello?
Yeah.
Next request to use the handset.
Is it better?
Your voice is not clear.
Okay, just give me a second.
No,
actually your voice is breaking. Can I request you to also come in a network area?
Is it better?
Yeah.
Yeah. So a couple of data points first. Can you share the impact of RM cost or commodity cost in 1Q? We have already witnessed in what we expect in second quarter. And secondly, the price hikes taken in 1Q and till August till date.
So price hike that is come in the last quarter is about 5%. And on the rubber side, Q1 was about 160, and currently it's about 155.
Okay. And secondly, why do you believe the lower RM cost will only reflect towards fourth quarter and not earlier than that? Is it because of the contracts which we have?
Yes, we have the contract, and normally we keep the 1 month for 45 days inventory as well as material is in transit. So when we import the materials, that has already been booked and is in the ship. So our impact will be coming 1 quarter later.
Okay, got it. Thanks. I'll fall back in queue.
Thank you. The next question is from the line of Pramod Amthe from InCred Capital. Please go ahead.
Yeah, hi. Couple of questions. One, if you look at the Europe agri replacement tire industry, it has collapsed by almost 20%. And still in the first quarter, in this quarter, we have been able to grow the volume by 20%. So, and you are giving a commentary that your dealers are destocking. So what is your stock level in your stockyards and dealers now versus the industry average?
We don't have the breakup of what is there in our dealers' stock levels, but more or less the distributors are about 20% higher to what they were earlier, and their demand is yet going on, so the end user demand is yet strong, so they are reducing that level to bring it down.
And second one is with regard to EBITDA margins. Even though some of the pressure seems to be transitory in nature, the commodity and also the freight, but it's like almost like a 5-year low margins for you. Considering that you have added capacity and there are excesses in costs which might have happened, do you plan to initiate any aggressive cost-cutting measures so that along with the market recovery, you should be able to get the margins back to the historical much faster?
So cost cutting is a continuous step that goes on in the company. When we have good quarters also, it's not that we don't look into cost cutting. That is something that is done regardless of the result, because if we can save anywhere money, why we should not save? So that is not a result of this, but that is continuously ongoing.
And the last question is, with regard to, if I look at your annual report, the exposure which you are taking for AIF and startup investments seems to be continuously going up. What's the rationale to fund it through the balance sheet? One. Second, can you give a guidance in terms of next 3 years, how much you plan to invest in this area?
So as we told earlier that was done last year to park the funds, and now when the capex cycle comes, the money will be used for that. So we don't know. That was a temporary sort of nature parking of funds, which was done.
Thanks a lot.
And we do not foresee any new money going there. towards that.
Thank you.
Thank you. The next question is from the line of Rishi Vora from Kotak Securities. Please go ahead.
Hi, sir. Thank you for taking my question. Just one question on realization, right? So historically, you used to do 260-265 rupees per kg of realization. And obviously, there is price hikes which you have taken, but there is also some element of, let's say, freight adjustments which happens in realization per kg. So once this freight cost comes down, where do you think are our stable realizations would be, let's say 1 year, 2 year down the line?
It's difficult to put a number and tell you this is where we will expect it to be because of the product mix and, it's FOB, CIF, so that will be difficult to put a number, but, there will be some, as we going down, there may be some cutback in the realization also because that will be needed to be passed on, but it's difficult to put a number and say this is where we expect the range to be. But what we can say that regardless of the realization, at the long term, we've always strived and maintained that our endeavor will be to maintain an EBITDA margin of 28 to 30% on long-term basis.
Right.
So, that is where we will strive to be.
So just to follow on your current realization of, let's say, 325, 330 rupees per kg, what would be the freight related realization increase? If on this base, if you can give us some idea, that would be helpful.
That we can't give that number now.
Okay, sir. And sir, just a last question on, do you expect RM inflationary pressure in second quarter as well?
Yes.
And you haven't taken any price hike in the current quarter, as in the second quarter, in July and August, right?
No. It's the market is challenging, so we are not able to pass on in this quarter.
Okay, thank you so much.
We just did a 5% in the Q1, so it's difficult to continuously pass on because, the marketplace at the moment.
Okay, thank you, sir. All the best.
Thank you. The next question is from the line of Nishit Jalan from Axis Capital. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. Sir, two questions. First of all, on demand side, we can understand that heat wave would probably be impacting some demand of agri in Europe. But you have also talked about some demand caution on the US front, highlighting inflationary pressures. And then we are also hearing about recessionary concerns on Europe. So in that context, how do you see demand from the next 1 year perspective, other than the temporary issue that probably you are foreseeing right now in the European agri segment? How are you seeing it in US and all? And a related one on that, we are seeing a volume decline in the rest of the world market for the last 2 quarters now. So any comments on that? Any market in particular where you are seeing some concerns which have started to come?
So, if you see in the last couple of quarters, our production was already maxed out. So we had to sort of ration the goods. So that is why certain markets have shown negative. For the last 2 quarters, it's not that the market demand was falling. It is we were rationing the products to different areas. So that is it. Long term, we see the opportunity is strong. We believe the markets will come back, and maybe a couple of quarters could be challenging. But overall, in the long term, the opportunity is good, and we foresee it to be strong.
Yes, sir, definitely long-term opportunity is good. But specifically from the Americas on the US front, the comment, that comment seemed more macroeconomic concerns on the growth, inflation, and all this. It's probably unlikely to go away in just 1 or 2 quarters, or some views over there and pick up again. That's what you feel.
Sorry, your voice muffled in the last couple of sentences.
So what I was
comment for the US?
So basically in US, what you have highlighted, the concern of inflationary concerns or basically macroeconomic slowdown, that is probably not going to go away in the next 1 to 2 quarters. Do you see that next 1 year or 1.5 years could be challenging in US because there is no weather-related issue in US? It's primarily impacting probably the European agri market. So in the US market in particular, how are you looking at that market from, let's say, next 3, 4, 5 quarter perspective? I understand that the demand will be good over the medium term, but purely from the next 1 year or perspective.
So we believe in US also the market for us would be good despite these trends, inflationary trends, because we, at the moment we are at a stage of growing. So a lot of foundation work had been done and results have started coming. So if you see in this current quarter also, Americas was about roughly at about 22-23%, up from about close to 18%, and a market, we had a growth over there of about 47% in America. So it's, that we think, yes, the 47% growth maybe come down slightly, but overall it'll be good for us.
Got it, sir. Got it. And so secondly, on the freight part, I think another participant asked it. So if I have to put it differently, this quarter, your freight cost per ton was about 47,000 rupees, right? Historically, if I look at freight cost per ton has been about 11 to 13,000 rupees. So fair to assume that the increase of about 35,000 rupees, almost half of that you mentioned that you are passing it on to the customer. So fair to assume that 15 to 20,000 rupees per ton is the realization, is reflecting in realization which will normalize going ahead as freight costs also normalize.
Yes. Yes.
Okay. And lastly, what was your net debt level that you mentioned? Sorry, I missed that.
Our net debt
750 crores broadly.
Sorry, 750 crores, right?
Yeah, very broadly.
Okay. And sir, capex, what are we looking at this year and the next year?
So this year we have already announced the capex which is ongoing, which is about roughly at about 900 crores. From the announce we have expected this year will be about 900 crores in the overall picture of what we have announced.
And any rough number that you can share for the next year?
Next year we are working. We have not we are yet on the drawing board for the new greenfield or brownfield project that is in work in progress. So we've not yet put numbers together. We are not ready to put it up to the board yet. We'll probably wait for. It's in the drawing board at the moment.
Okay, thank you. Thank you so much.
Thank you. The next question is from the line of Priya Ranjan from HDFC Asset Management. Please go ahead.
Yeah, hi. My question related to the currency depreciation of euro particularly, and related to the pricing gap between you and probably the premium players. So how do you see the market evolving in that context? Because your cost will be in rupees and your selling will be in the euro, and while the local manufacturers will have advantage because they have their cost will also be in the euro, and the selling price will also be in euro.
To the extent that we have exports, Priya Ranjan, there are imports of raw materials. So from a currency movement, there will not be too much of impact of the currency movement that you are seeing today.
No, but the problem is with the euro.
On net basis, we are hedged for the year, and that hedge currently stands at about 85 to a euro for FY23.
Okay. But beyond that, so is the price, the future price hike will also be depending on the price gap between what you follow between, say, Michelin or the premium guys and you? And your raw material will typically be in dollars. So dollar has actually appreciated while the euro, etc. has depreciated. So, the cost side, you are seeing pressure in terms of dollar, but that can be offset probably from the sale of non-euro side. But the euro side, because that is the most heavy volume for you guys. So around 50% coming from the Europe side.
The differential between tier 1 and us will continue to remain at the similar level. The difference will continue at that same level.
Okay.
Thank you. The next question is from the line of Siddharth Bera from Nomura. Please go ahead.
Yes, sir. Thanks for the opportunity. Sir, my question is on the capacity side. So right now, if you see, we are already at about 330, and you are saying you will reach by about 350 by the end of the year. So do you think for growth, you may need to have more capex requirement or capacity coming up next year, or do you think current levels are sufficient for growth in the next year?
So yes, we are, as I mentioned earlier, that we are already on the drawing board to look at either a brownfield or a new greenfield project. So once we have more details, we'll share with you. But I think by that's in the pipe. So are absolutely right that it needs to be done, and we are working on that, working towards that.
Got it. And generally, how long would you think it would be required for after you decide for the capacity to sort of come on stream?
So if it's a brownfield, it will be about 1 year, and if it's greenfield, it will be about 15 to 18 months.
Okay, got it. Thanks a lot.
Thank you. The next question is from the line of Joseph George from IIFL. Please go ahead.
Thank you for the opportunity. Just one question. So if I look at your previous down cycles, once demand weakens, it has lasted for 3 or 4 quarters, and we don't come across too many instances where 1 quarter demand is weak and then immediately the next quarter demand bounces back. This time, if I look at your guidance, you said that 2Q would be weak, but you've maintained your full year guidance, which implies that you're expecting a volume bounce back, say in 3Q and 4Q. So I want to understand how is this weakness different compared to what we have seen in the past? How do you feel confident that after 1 weak quarter things will bounce back, and as a result you have maintained your full year guidance? That is one. And a related point is that you mentioned that underlying demand is strong, but distributors are cutting back inventory, because of which your offtake is lower. Do you think it's possible that the distributors are seeing things on the ground much better, because of which they're cutting down inventory in anticipation of upcoming weakness in retail? So if you can respond to that, thank you.
So I think your second part answers the first question. What we see at the end user level, the demand is yet strong, and there is a good pickup over there. So that's why we are confident of these numbers. What we are saying that the destocking is happening at the distributor level because of the huge excess. I mean, there's been a big jump in the last quarter and last 2 quarters actually. Both the quarters have been higher than the previous one. So that is now reaching them. Also, the shipping times have started to come down. So people are not, earlier what was taking 4, 5, 6 months to reach is now reaching in about 4 months, because availability of containers has eased out. So that's why they are also looking to hold back some orders and deplete little stock and then reorder. So that's why we are confident that in the Q3, Q4, hopefully the demand will come back, because we don't see it as a retail issue. We see it only as a temporary destocking issue.
Okay, but the reason that you gave, which is heat wave, etc., seems to be an end demand issue rather than a destocking issue.
Those are heat waves are coming, but I mean, if you see last week again, parts of Europe had good rain. So those are that's why we said that its weather patterns in Europe are it's a challenge for us in the near term. But we are quite confident the way the last 1 week rains have all started coming, that it may ease out.
Got it, sir. Thank you.
Thank you. The next question is from the line of Sanjay Satpathy from Ampersand. Please go ahead.
My question again is relating to the demand. Are the dealers cutting down on their inventory primarily because they anticipate a price cut because most of the raw material as well as freight costs, etc., are going down?
Yes.
Okay. And unlike last 2 years almost, you have been seeing this cost pressure, and you have been taking hit in the margin, and your long-term guidance, which is not really being realized because of the cost pressure. But at the same time, considering how the dealers are behaving, so do you think then your long-term goal will get pushed out in terms of reaching back better margin? That you will be required to give price cuts much before the cost benefit kind of comes to you?
No, we have been able to pull that in the past also. So we are quite confident we will be able to pull that. And then that's why we say that our endeavor is to maintain an EBITDA of 28 to 30% on long-term basis. And, we are quite confident with looking at our past experience that we've been able to do that. Pull out the gap between passing and holding back.
Okay. And if I just ask a little differently, like in the end of March quarter result, the commentary in terms of margin was as if like March quarter was the worst quarter, but still the margin fell further. So what really went wrong between the quarter that the margin again kind of?
I mean, if you see in my commentary, I told you that we've had an impact between the 2 quarters of further hike of freight to the tune of nearly 0.75%, and also the raw material also had an impact of about 1.5%. So those two things coming together has had an impact on the margin.
Yes, I understand that, but most of the actual spot prices actually went down. So it is a case of your long-term contracts hurting you, right?
Yes.
Okay, so that is what. So the market is not going to wait for your long-term contract to kind of ease out before you get the benefit. So is it kind of a bit of a wrong call in terms of management getting too much of long-term contract, or that is something which will ease out probably in quarter 3 itself? That is what you are indicating.
That is our normal business. Means whatever quarterly contract we are doing, that material comes in the up to mid of the next quarter, and 1.5 month inventory we are maintaining. So always there will be a gap of 1 quarter between the price correction between market and our price correction.
Understood. So what I'm asking is that did you take excessive inventory or long-term contract because of the supply situation, or it was a normal business, so the 1 quarter time it will bounce back? That is the only difference.
It's a normal business call, because it's difficult to always time that when will be the lowest or when it will fall. You will have a situation when you're waiting for stock, because also in the previous quarters availability was challenging. So if I had waited too long, there would be a situation where I would not be having material to produce. So that would be another problem. So it's, at the end of things, it's very easy to say that you management did this wrong or right or what, but it's a business call which happens and it's continuous process.
Okay. I was just trying to say that it is a normal business or a speculative kind of.
No, we don't speculate.
It is normal business.
We only do our regular business. There's no speculation in our business.
Okay. Thanks a lot, sir.
Thank you. The next question is from the line of Basudev Banerjee from ICICI Securities. Please go ahead.
Yeah, thanks. A few questions. One, as you rightly mentioned, that you are planning next round of capex either through brownfield or greenfield. Just wanted to know, out of 360,000 ton, Bhuj is now at 2 lakh ton. So how much incremental debottlenecking Bhuj can see? Is it 1 lakh ton more?
Yes, we have space for doing brownfield over there, so that can be done up to 1 lakh here.
Yeah. Second thing, as many of the participants asked a similar question, just for more clarity. If I look at YOY volumes are more or less up around 20%, and other expenses are up more than 100%, part of which is because of multifold increase in freight costs, power cost inflation. Just wanted to understand, is there any temporary elevated brand building activity going on for past few quarters, which will culminate or nothing like that? All are sustainable brand building expenses in that line item.
So a lot of the brand building, especially in the Indian cricket sector, happened in the last quarter. So those expenses have all come and clubbed together. And, so that is what you are seeing. It's not that it is increased. Our sponsorship related spends are for the year are between 120 to 130 crore, and that is continuing. So there's no sudden jump on that. It's just that it has come in 1 quarter. Some payments have come in 1 quarter.
So if you can highlight, sir, out of that 120, 130, how much was in Q1 itself, that will give more clarity that that expense will normalize in coming quarters, so will remain at that level for full year.
Yes.
So if you can highlight, sir, what was the quantum accounted in this quarter?
Right. We don't have that exact number now.
But one can assume to be almost half of the full year number. Will that be right, sir?
About 40%. Around 40%.
Okay. Thanks. And last question, sir, like with many participants also asked, so will it be right to assume that till date, where we are more than almost halfway through Q2 itself, despite heat waves and adverse macro issues, retail demand in Europe for you is still very much steady?
Yes. The retail demand is steady. That's why we are confident of hitting those numbers.
Sure. Thanks. That's all.
Thank you. The next question is from the line of Chirag Shah from Edelweiss. Please go ahead.
Yeah. So thanks for the opportunity. So my first question is a follow-up on the investments in equity instruments directly indirectly that you have done. So 22, we saw a reasonable jump, including if I take into account ETFs also that you have parked money. Generally, in the past, you have not chosen equity instruments in that. So what has changed and how should we look at it?
No, so as we said, there is no change. It was just temporary parking when money was available. So, and because those times the debt rates were very, very low, and that's why we had done this. But as we've already said in my earlier commentary, that no new money will be put in that. So, as the capex cycle comes, this money will be used for that. So, it's just a temporary arrangement done since we had the funds at that time.
Okay. And the second question was on the outlook that you shared. See, when I look at your per kg of per ton cost sequentially, there seems to be the freight cost is also has not gone up significantly, maybe by ₹1 or so per kg. Okay, see, I'm talking Q4 to Q1.
Yes.
Okay, so the sequential increase is not as significant as you are indicating in that sense. So, how does your contract on this work for you? We can see a immediate reduction in your freight cost as the rates go down, or even there could be some lag?
No, there should not be a lag. There you'll see an immediate impact, positive impact.
And that impact, when can we expect? Can we expect from Q2 itself, given that the rates have started coming down, or it will take some time?
So what we said is that we'll start seeing the benefit from this quarter itself, but significant impact by the time you start seeing it, because it starts slowly and then it builds up. So you will see the big chunk of that relief in the end of Q3.
End of Q3. Okay, and the last question on demand. Now, while you are confident about achieving your guidance number, if push comes to the shove between volumes and margins, how would you look at, given the macro uncertainty which is there, and beyond the point, even you may not have clarity on that. So, would you look at achieving the targeted volumes at the cost of profitability, because utilization is more important than margin, or you would focus on per kg or per EBITDA per ton profitability? So how should we understand the balance from here on, assuming there is uncertainty actually turns on the adverse side for us?
So for us, margins and profitability is more important. We have never compromised on that. So we will always focus to build that. So if we have to choose between one, it would always be margins.
Okay, sir. Thank you very much. This is helpful.
Thank you. The next question is from the line of Sameer Dosani from ICICI Prudential AMC. Please go ahead.
Hi, thanks for the opportunity. I think maybe this is answered, but just to understand, when I look at sequential per kg metrics, right? Your realization has gone up by 12 rupees, raw material cost maybe by 9 rupees, and freight by 3 rupees. So your realization really covers the impact, right? But if I look at EBITDA per kg, it has fallen down by 10 rupees sequentially. And can you explain? We have answered it, but can you explain what is the kind of impact that's there in this quarter, and how can we assume or maybe look at this number going forward in few quarters?
So you have to add the power cost also, because as the demand went up, we did not have our own captive power plant on place, so we had to use coal, which was having an impact on the power cost. And as for that, already the power plant is going to be set up. It's in final stages. With Q3 of this year, we should have that on board. So that should have a significant change in the power cost. And also as I mentioned, that some of the advertising and branding costs for the whole year came in this quarter. So that should ease off.
Right. And how, just to understand this advertisement, how big could it be, I mean, in this entire scheme of things, just for this thing?
I don't have those exact number breakups on that.
Okay. And secondly, when I look at your employee expenses on a sequential basis, it has gone up by 20%. Is there some one-offs, or do you expect this to continue, or what is the trajectory that would be there in this employee expenses?
So as you see, I mean, in the last quarter, we had incremental new plant come up. So those costs have come where the whole production is not come, because that is a modular, production increases modularly, but the manpower we have to take fully on board. And also during the summer months, we normally have some incentive for the people because, to retain them. So those two things have come in that quarter.
Okay. And, if you can, obviously you have provided a trajectory around the margins, but if you can, can you just provide some outlook on a per kg? How do you see that panning out? Will it go back to the earlier? How do you see that, I think, in next few quarters?
I mean, all I can say is that we are expecting relief on logistics and on raw materials, so those should come back. Our endeavor is to hit 28 to 30%. And as I said earlier also that, our focus has always been on margins, not on volumes. So those things is where we see very difficult to put a number on every quarter, where do we see the numbers going next quarter, what is that. But yes, we see some relief in both the areas where our major pain is. And also power and fuel, we have already initiated the captive power plant coming up, and that should also impact. So all the three areas which are a pain, you will see relief in that.
No, so where I'm coming from is because all of these, the raw material and freight would be majorly pass on for us, right? So, in EBITDA per kg basis, it won't.
So I'll interrupt you because when it went up also, we were not able to pass on the whole thing. So when it goes down also, those things, we've done it in the past also. So, there's always you keep some part of it and,
Right.
It's not a full pass on. It's like how, in both sides, when it goes up, you don't do a full pass on. When it goes down, you don't do a full pass on.
Right. Understood. Thanks for the detailed answer. Thanks.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Sir, as the manufacturing cost is increasing in Europe and US, how do you see the opportunity in terms of the gaining market share because of the lower cost benefit? Can you throw some light on the market share in Europe and US in agri and OT or both sides?
So yeah, we see the markets to be good, both the opportunity to be good, and that's why we are looking at, we are on the drawing board for our next expansion, and we personally believe that there's going to be a good opportunity for us in all over, including India and across the globe.
So how much market share you gained in the first quarter in the Europe and the US?
No, we don't have the individual breakup.
Okay, sir. And your contribution from Europe is going down in percentage and absolute terms, and contribution from
absolute terms is going down in percentage terms, but not absolute terms.
So is it because of the logic?
So percentage may go down, but the absolute term is growth. There is a growth, about 14% growth is there on number terms, on absolute numbers.
So Europe on a YOY basis has grown 14% in volume terms. There is no degrowth per se in terms of volume. Of course, as a contribution to overall sales, it's come off.
I'm talking about the quarter-on-quarter basis.
Quarter-on-quarter basis.
So yeah, Q4 and Q1 are never to be compared.
Yeah, because there are cyclic businesses, no? So you can't compare the year quarter-on-quarter.
Okay. So you have lost some volumes in the Russia and Ukraine. So what is the percentage of that, sir?
No, that's not a big part of Europe for us at the moment. So we did not see any major impact of that.
Okay. And my last question is related with the Indian market. In this quarter, we have seen a higher versus the other markets. Is it the region of the sharp contraction on the margin side also?
Is it
also a region for the sharp contraction in the margin side? How much? So how much difference is the margin of export versus domestic, sir?
Domestic is always 2-3% cheaper as compared to export. So that is the reason.
Okay, sir. That's all from my side.
Thank you. The next question is on the line of Senthil Manikandan from iThought PMS. Please go ahead.
Hi, sir. Good morning. Thanks for the opportunity. Sir, my question is from the competition perspective. We have seen a couple of major players who are expanding the capacity on the off-road tires in India, and also a new player has put up a full greenfield plant in Gujarat. So they are also planning to export from here, and the business model is quite similar to the company. So if you could just share your thoughts on the same thing. Thanks.
So what we are saying is at BKT we see for BKT the branding that we have done over the last 5, 6, 7 years has really helped us grow. Our brand equity has grown, brand recognition has grown, brand acceptability has grown, and with the current market share of 6%, we believe there is an opportunity for us to grow in our business, for which we are looking and seeing how we can further capitalize on this opportunity. And that's why we are looking at expansions.
Okay, sir. Thank you.
Thank you. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi. You mentioned that the stock with distributor is 20% higher. Is it like quarter-on-quarter higher, or it is compared to pre-COVID normal stock level that is higher by 20%?
It's between year-on-year quarter, compared to the 2 quarters yearly.
So, any color in terms of months, how that would be in terms of distributor stocks right now versus normal pre-COVID?
So they normally they would ideally be between 2.5 to 3 months, and we believe it's slightly higher than that.
Okay. And secondly, how do you see the competition Chinese companies? I think in between, because freight costs went up a lot from China, their volumes have come down across different markets. Do you see that increasing now? Are you seeing any trend in that?
No, we are not. At the moment, we are not seeing any trend in that.
Okay. Thank you. That's all from my side.
Thank you.
Thank you. The next question is on the line of Ronak Sada from Systematics. Please go ahead.
Yeah, hi. Sir, a couple of data points. Firstly, the Bhuj production and the raw material cost, synthetic rubber and steel wire, if you can share.
One minute, just 1 minute.
Sure.
So we don't give plant price breakup, but total production is about 84,000 tons.
Okay.
And
synthetic rubber cost varies because 2 different variants are there. It is 165 to 200 rupees per kg.
Okay. And steel wire?
Steel wire is around 110 rupees a kg.
Okay. And sir, did I hear it correct? Did you say net debt at 750 crores?
Yes, approximately.
Okay. But because in quarter 4, the net debt was around 1,900 crores. So is there a very sharp movement?
There is a gross debt of 2,750 crores.
Yes.
And
1,900 was the gross debt.
So gross debt today is about 2,750 crores, and we have cash and cash equivalents of 1,975. So broadly, it's about 750 crores of net debt.
Got it. My mistake then. Sir, thanks for that. And secondly, sir, if you can help us understand now, how is our exposure to USD denominated cost, both on operating level and capital investment side. And is that also a big part in how our realization and costs are moving both in tandem, and hence the margin looks optically lower? So if you can just help us understand what are the USD denominated costs right now.
I think there is a natural hedge between the dollar expenditure and dollar earnings. So broadly, there is no structural change in terms of how the currency is impacting the business.
INR depreciation versus USD, that would inflate both our top line and the expense side as well, right?
Correct. But from a margin perspective, that's
Margin
not
perspective.
a major challenge.
Got it. And lastly, again on the demand scenario, based on the second half run rate, then do you believe it can cross upwards of 1,75,000? Is that the kind of estimate are we building in, given Q2 will be weak, or despite, when you say Q2 weak, is it more like a substantial drop in volumes quarter on quarter? How exactly do you define when you say it will be tepid?
So we don't want to put a number to it. We've given the directional movement, and we are quite confident of that.
Okay. Great. Thank you.
Thank you. The next question is from the line of Abhishek Singhal from Naredi Invest. Please go ahead.
Good afternoon, sir.
Hi, good afternoon.
When will you start pass on the increased cost of raw material to the customer? And second, carbon black plant start in Q3 FY23. So how much revenue will increase, and also how much margin will increase from this carbon black plant?
So carbon black plant turnover, we will be having approximately 800 crore rupees in this year, and margin will be at industry average.
Sir, what is margin?
As per industry average.
Okay. And when will we start pass on the cost of raw material?
Cost of production we are already passing from the last many quarters, and now further cost passing is difficult because raw material prices have already started moving downwards. So we will wait for the downward passing. First we will absorb whatever we have could not be passed, and thereafter we will start passing if this continues downward.
Okay. And our thermal power plant, so sir, from where will you?
We don't have a thermal power plant.
Okay. So this 20 megawatt plant is renewable energy plant? We planning to?
We have currently two plants. One is already operating, and another we will be operating in quarter Q3.
It is a thermal power plant or renewable energy?
It will be used from the carbon tail gas. Whatever carbon we produce, there we will be getting tail gas. So we will be utilizing the tail gas, and because till tail gas was not available, we use the coal.
Okay. So from where we get coal?
Coal we buy from the market, Adani Port, or many people are selling it.
Okay. Thank you.
Thank you. Next question is on the line of Nishit Jalan from Axis Capital. Please go ahead.
Yes, sir. Thank you, sir. Just one small question. Typically, we don't have any industry body which gives a market share data. So when you say 6% kind of a market share, do you do any calculation from your side, or do you get any third-party data to track these market share?
There are agencies who do tracking. They have estimates, and our own knowledge and research is also ongoing, where we can track roughly where we are and what the numbers are.
Okay. Sir, because where I'm coming from also is if I go back 3 years in time, then also we used to talk about 5-6% kind of a market share. So have we not gained any market share in the last 3-4 years?
So what we used to talk earlier was 4 to 5%, and now we are talking 5 to 6%. So market has also grown, and we have also grown. So it's a combination of both.
And sir, would you have any sense as to what would be the kind of market share that the top 3 players would have in the market and all? I would assume that Michelin would be the leader, and Yokohama would also be another big player. But any sense on the market share of the top 3 players that you can give us?
No, I can give you my numbers. I don't have their data.
Okay, sir. No worries. Thank you so much.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing remarks. Thank you, and over to you.
So thank you to everybody for coming on this call, and we hope to see you next quarter. Till then, stay safe. Thank you. See you.
Thank you very much. Ladies and gentlemen, on behalf of Anand Rathi Share and Stock Brokers, that concludes today's call. Thank you all for joining us, and you may now disconnect your lines. Thank you.